Okay, I think it's 4. So Anita, you can start the recording.
Done.
Okay. Hi, everybody. Welcome to Personal Finance from Mystery to Mastery, our 8th session in the course. And today we're going to be concluding our exploration of the borrowing pillar, which, as we've discussed, is one of the most double-edged and misunderstood pillars in personal finance. So we'll give you our final recommendations on how to use borrowing in this class. For anyone that's missed prior videos, they're all available on our YouTube channel, so check them out. And feel free to write in at advisory@bharosaclub.com with any questions. Before we get started today, wanted to let you know about our plans for the advanced session. So many of you know we just finished a session, series of sessions on options. The next advanced sessions that we're going to explore is actually doing some more research on companies and walking you through research on companies like we did with Britannia for some of the popular listed shares in the market. So that should be a fun one to explore with you guys. So stay tuned for that first video and that next week. Okay, great. Let's get started here today on borrowing. So what did we cover last session? So we understood that borrowing was one of the most misunderstood tools in personal finance. Either people undervalued borrowing and thought it was too risky to ever do, or people overvalued borrowing and thought it was, riskless. The real answer is in between, and understanding how to use borrowing well tool for you. We explored some of the dangers of borrowing poorly and showed you how that can result in something called a debt trap. And we also understood at a high level how a lender evaluates borrowers and what this means for you. We're going to explore that a little bit more today. So what are we going to do today? We're going to first understand the importance of a credit score, how to establish and fix your credit score if there are any problems in your credit score. We're going to explore the do's and don'ts of borrowing. So recap our recommendations on how to borrow. And then we're going to conclude the pillar with understanding how to compare lender offers and pick the best deal when you're trying to decide which loan to go for if you're looking to borrow. And then we're going to introduce our next pillar on protection, which is the next area that we'll cover in this course. So let's start with the credit score. So the credit score, we talked a little bit about this last time, but it's the single most important factor that a lender looks at when evaluating borrowers. Why is this? Because a lender does not know you on a personal level. And so they rely on your credit score to understand your character, how well you've repaid your loans in the past, and they use that as a proxy for how risky of a borrower you are going to be for them. So the punchline is, if your credit score is good, then they feel very comfortable lending to you. And if your credit score is poor, then you may have a very hard time getting a loan. So your credit score is generally built by borrowing in the past. So if you've used a credit card, if you've borrowed in the past and repaid your loans on time, chances are you have a good credit score. So people that don't have a credit score yet, so if you're young, you've never used a credit card, you've never borrowed, you may not even have a credit score. So those are called new to credit people. So we'll discuss what to do if you're new to credit and how to build your credit score. So what's a good credit score and bad credit score? So a good credit score, we consider a very, very good credit score to be above 750. Lenders love people with credit scores above 750 because they're very safe in their view. What's a bad credit score? Anything below 700 is something where you're going to start seeing higher interest rates because your credit score is not perfect. And actually, being new to credit can sometimes still be better than having a bad credit score. So you can actually check your credit score for free at Paisa Bazaar. So that's a great way for you to get access to your credit reports and see what your credit score is. So check that out for people that are interested and don't know what their credit score is. You can check it there. So how does a good credit score make a difference? In a lot of ways. So first of all, you're going to have an easier time borrowing and finding lenders that are willing to borrow for you. So when you're in a pinch and you need to borrow money, you're going to be able to do it easily. Second is you're going to be able to borrow at a cheaper interest rate. Remember, the interest rate is the fee that a lender charges you for lending you their money. If you're lower risk, they're going to charge you a lower fee. And you're going to have a much easier time getting the loan. You may be pre-approved for the loan and you So let's give you an example to make it crystal clear how a credit score can make a difference. So this is a chart that I pulled from a lender's website, which shows you the different interest rates that they offer for customers based on whether they're salaried, non-salaried, and what their CIBIL score is. So CIBIL score is the credit score. So you can see very clearly that as the credit score falls, the interest rate the lender charges goes up. And this chart doesn't even tell you about the documentation process for these various kinds of customers. So beyond just the interest rates, it's also much loans. So this is really why it's really important that you work on your credit history. So let's figure out how you can do that. So the first thing is, what if you're new and you don't have a credit history? How do you go about building this? So the best way to do that in our view and our recommendation for our members is to get a credit card. You may not need to borrow on a daily basis, and it doesn't matter. The real reason you want a credit card is because a credit card helps you build a track record of repayment and does so in a very, very easy to use fashion. So even if you're not borrowing for long periods on your credit card, just having one, just using it for purchases and paying it back regularly is a great, great way to build your credit score. And you'll also get perks that credit cards offer members. So it's a great tool for people to build their credit history. So let's figure out how we recommend you use it. So on our webpage, you can read more about it on our website, and under Learn, we have a module on how to use credit cards effectively. But the short answer here is do not use them to borrow for long periods because the interest rates they charge are very, very high. We recommend actually that you pay your credit card balance off in full every month. That way you're not technically being charged any interest rate and you're building your credit score and it's helping you build a track record of repayment, but you're not even paying a cent of interest to the credit card company. So this is something that we really, really recommend that our members do. Some of you may have trouble getting a credit card if you don't have credit history, because you may be in a chicken and egg situation where you need a credit card to build your credit history, but lenders are not willing to give you one because you don't have a credit history. So what do you do if you're in that situation? So there's a great product called a secured credit card, which can help you build your history no matter what. When a lender is concerned that you don't have history, secured credit cards basically is you give the lender a fixed deposit, let's say 5 lakhs or whatever, right? And the lender will lend to you against that fixed deposit. So if you don't pay back your bills, then the lender can claim your fixed deposit. So in this way, the lender's not taking a big risk on you. You're still getting to build your credit history, and it is a great starter product for people. And as your credit history builds, you can get a regular credit card, which does not require any fixed deposit or security for the lender. So this is a great, great product for people that are young, don't have a credit history. So again, it's a secured credit card. So that's a great, great way to establish a credit history. More details of this can be found on our website for members under the Learn tool. Okay, so what do you do if you have a low credit score? So this is a trickier problem to solve than if you don't have a credit score history. So because the main issue with having a low credit score is your credit history stays valid for a very long time. So if you don't repay a debt or you're late on payments chronically, it'll take a very long time. In the US, it's 7 years. I'm not sure how long it takes in India to roll off your credit history, but it takes years for things to get cleared off your credit history. So you need to be patient, but it is a solvable problem. And our recommendations are, if your credit score is lower than the ranges we recommend, here are the things we should do. The first is make sure there are no errors on your credit report. You can look at the credit reports and see why you have a low credit score. And if you find anything that doesn't make sense, call up the bureaus and ask them to investigate, because credit bureaus do make mistakes from time to time. So it is possible that your credit score is low because of a simple mistake. So first you want to check for that. Second, if you have any debts that are outstanding that you haven't repaid, that are late, try to settle those or repay them. So if you can repay them in full, that's the best. If you can't, call the lender and try to work through a settlement process with them. That's very important to resolve these outstanding debts eventually. And the third is you want to start rebuilding a good credit history. So how do you do this? Because you have a bad credit score, it's going to be difficult to get risky loans given to you. So the best way to rebuild your credit score is to look for products that are secured. So like we did with the credit card, right? We offered an FD to the lender and said, lend me against that. Similarly, there are other products like gold loans, where you give a piece of jewelry to a lender and you get money based on the value of that jewelry. So that's another way to get money and a loan which you can use to rebuild your credit history, even if you have a low credit score. So that's a good way to try and rebuild this over time. And it is very possible to rehabilitate a credit score. You just need patience and you need to follow this process, and you'll do it over time, and it'll pay enormous dividends for you when you actually need to borrow in the future. So we really recommend, don't let a low credit score remain low. Try and rehabilitate it, because when you do need money, it'll become a big problem if you can't borrow. So, okay, so that's the basics on the credit score. Now we're going to get to our recommendations on. So the first is, don't be afraid of borrowing. As we discussed in the last video, it's a valuable tool if used correctly. Sure, it can be very dangerous if you don't do it correctly, but anything in finance can be dangerous if you don't do it correctly. If you don't invest correctly, it can be very dangerous. Similarly, if you invest smartly, it can be very valuable. And if you borrow smartly, it can be very valuable as well. So how do you do it smartly? So if you follow these do's and don'ts, you're going to be on the right track. Don't borrow to fund consumption. We are constantly tempted by retailers to do this all the time. Anytime you walk into a store and the clerk tells you that, you know what, you can get this bigger TV and we have an EMI offer on it, it's zero interest, what do you lose? It's very tempting to fall for these offers, but the real problem with these are it's encouraging you to spend above your means. You don't have the money to buy that product. You have to borrow to buy it, and that's not a good use of borrowing, because you're not creating value for yourself. You're just buying a TV. How's that TV going to help you earn more in your life? So we say don't borrow to fund consumption as a rule, best to avoid, but occasionally if you want to do it, fine, but don't make it a habit. Next, don't be too aggressive with how much you borrow. Always leave a cushion. Don't buy the largest house that you can afford. Don't buy the largest car that you can afford. Just because you can afford the EMI payment today doesn't mean that something can't change in your life where suddenly tomorrow you can't afford it. A lot of people right now are really struggling because of COVID. They took out EMIs that looked very easy for them to repay. Suddenly they took a wage cut at work, and now they're having trouble paying their EMIs. And I know people personally that are struggling with this, right? So you want to be very careful with being too. If it does happen, you're going to be prepared. Don't be late in your repayments. This will ruin your credit score. Always pay back your lender on time. You should set up auto debits mandates in your bank account, NACH mandates, etc., so that these payments to your lenders happen automatically so you don't forget. Because even a single late payment will show up in your credit history, and it's not something that you want to have happen. So make it very easy for you to stay current by setting up these auto debits. Okay, what are the do's of borrowing? So do borrow for productive purposes. While we don't encourage you to buy for consumption, we do encourage you to borrow for productive purposes. What does that mean? What is a productive purpose? It means that you create value for yourself. You use the money you borrow to do something that makes your business better, your skills better, your life better, your family better, and that helps you as a unit become more and more financially well off, and helps you pay back your loan. So things that help you earn more money are good uses of borrowing. Things that more money are not good uses of borrowing. Do think about downside risk carefully. Always think about what could go wrong. Maybe I want to borrow to open a new store in my business. But I have to think, what if the store doesn't hit my sales projection? Am I going to be able to repay my debt? What if I can't get a job after I get an MBA? Am I still going to be able to repay my debt? How likely is that? All these questions are questions that you should ask yourself and think about when you're borrowing. Do shop around for the best deal from a lender. Lenders, and I'm going to show you how to do this because it's very complicated to compare offers from lenders. And they use all kinds of fancy terms to hide fees and all this kind of thing. So we're going to figure out how to cut through all that jargon so you can compare offers from lenders accurately. And do build your credit score. Even if you don't need to borrow, and you can't even imagine needing to borrow in the next 5-10 years, we still recommend that you take the time to build your credit score. Why? Because you never know when you will need to borrow. Something unexpected could happen. You may have expensive hospital bills that you need to borrow to pay. You may find a dream house that you didn't think you wanted, but now you want. All these things, right? Borrowing, right? And we can't expect them necessarily all the time. So it's very good to have your good credit score ready in case you ever need to borrow. And then you'll be able to do so easily for a cheap rate. So always work on knowing what your credit score is and keeping it high. Okay. What is the most important rule amongst all these things we've discussed? The single rule that if you understand, you will understand how to borrow smartly. Okay, this is the one thing that you really, really have to internalize. Borrowing works when you create more value than you pay to the lender. I have to pay my lender a certain fee for borrowing his money. If I create value in my life, financially or emotionally or whatever, that creates more value than that interest fee I pay the lender, then the borrowing is smart. That's a really simple way of looking at it. What am I giving the lender? I'm giving the lender interest rate. What am I getting for my debt? Well, it's maybe reskilling me to earn more income, more profit in my store. Is that more than the interest I'm paying the lender? If so, then it is smart use of debt. So if you can answer this question and think about, because life is uncertain, what the risk profile is around these items, then you're really going to borrow smartly. So this is the key to unlocking the power of borrowing. So really, really try to internalize this rule. Okay. Now we're going to get to how to find the best deal. And this can be really, really tricky. The reason that lenders have all these jargon terms and different fees are very simply, they want to make it difficult for you to compare their loan to other loans, and they want to try and play games to move fees from one bucket to the other so the customer can't catch it. So I'm going to teach you some of the tricks they play, and I worked at a lender, so I know how they play these games and all these kind of things. This is the kind of analysis you should do when you're trying to borrow to figure out what the good deal is. in the market. So let's start with some basics of understanding what the jargon is. So the first is the interest rate. So that's the headline fee for borrowing money. That's, as we discussed, the fee the lender is charging you to give you the loan. And it's typically expressed as a percentage of the amount they lend you, right? So maybe I borrowed 10 lakhs from a lender to buy a house. Maybe my interest rate is 10%. So that means every 10% per year, that means every year I owe him a 1 lakh fee if on that 10 lakhs I borrowed for as long as I borrowed that money. So that's the interest rate. Then there's some other fees that lenders try to sneak in. So there's something called a processing fee. That's an upfront fee that a lender charges you at the time of the loan. So for processing your application, etc., etc. So this is a way that lenders like to sneak in more money to their wallet, to their account, right? And a way of charging you extra. A lot of loans, most loans have processing fees. So it's very important to also stay on top of how much they're charging you on the processing fee. Some lenders also have something called an application fee, which they charge you on top of the processing fee. So you also want to include that in your analysis. Then there are also some other charges that lenders can have. They can call it valuation charges, they can call it whatever. But the key here is identify all the different fees that you're being charged and include them in your analysis of what you're ultimately paying the lender. The other thing that a lot of times lenders will demand on large ticket loans, like let's say if I'm buying a house, if I buy a house, a lender has lent me money. A lot of times the lender will require that I take a life insurance policy out because they're worried if I die and my wife now has to pay back the housing loan and she doesn't work, how is she going to pay back that housing loan? So to cover that risk, sometimes housing companies will demand that I get life insurance equal to the amount of the loan so that if I die, that loan is repaid with that life insurance money. This is a very, very good thing. And it needs to be done. And it's something that you should think about when you're taking large ticket loans. Should I get a life insurance policy to protect my loved ones if I were to pass away from this debt? But the issue is a lot of housing finance companies and other lenders charge a commission on the insurance policies they're selling you. So you also want to be very clear how much of a premium you're paying for your insurance with your lender. And then the last feature that you really want to understand is the tenor. This is the period over which you repay the loan. So it can be a short tenor, 2 years, 3 years, 1 year. It can be 15 years. It can be 20 years. The general concept here is the longer that you have to repay the loan, the less your monthly payments are going to be. So we're going to cover this on the next sheet in an example. So let's actually try and work this out. Let's pretend for a minute that I was trying to get a housing loan. Okay. And I went to 4 different lenders. Okay. And each of them gave me a quote for how much of a loan I could get. So that's the first loan. The first line here is how big of a loan each lender told me I'd get. Okay. And now we're going to be detectives here and we're going to try and pick the best loan. Let's see if we can do that together here. So we can see that every lender except for lender C agreed to give me a 20 lakh loan. But lender C said, no, we can only give you a 15 lakh loan. Okay. So what does that mean? The purchase price of my house that I want to buy doesn't change, right? It's always going to be 25 lakhs. So in the case of lender C, since they're only giving me a loan of 15 lakhs, I need to put an extra 5 lakhs into the purchase price of the house. So this means that I need to put more equity if I decide to use lender C and use their proposal. So that's a very important consideration. Do I have enough money? That's kind of how we afford to buy the house. Now let's look at the next line. Tenor. So this is how long our loan period is going to be. So here lender A, lender C, and lender D are all at 20 years. Lender B is at 15 years. So lender B is only lending me this money for less time. So we'll see what implications that has later, but it's an important feature that you need to also understand when you're evaluating lending proposals. The next line is the interest rate. So that's the headline fee the lender's charging us. And you can see here giving us different rates. Lender A is at 7.25%. Lender B is at 7.3%, lender C at 6.9%, lender D at 7.25%. Okay, so if I was lazy, maybe I just say, oh, this is very clear. Lender C has the lowest interest rate, so that's the best deal. But we need to figure out if that's actually the case. And we'll see when we do the math, maybe it's not. Okay, then I looked at the upfront fees. How much is each lender charging me in upfront fees? So the processing fee, the application fee, any other fees that they're hiding. If I add all those up, what are they total? So in lender's A case, it was 3%. In lender B, it was 1.5%. Lender C, it was 2.5%, and 2.5% in lender D. Then the insurance premium. How much are they charging me for the life insurance? In lender A's case, 2%, 1%, 2%, 2%. Then what I did is I just added up all these fees. Okay, so total fees, just A plus B, I get 5%, 2.5%, right? The 1.5 plus the 1, 4.5% and 4.5%. So you can see there can be a very large variation in fees depending on lender. And if we just do a very simple calculation, if I'm taking a 20-year loan and I take that 5% fee that the lender is charging, how much does it work out to per year of the loan? So I just take the 5% and divide by 20, I get 0.25, get 0.17, 0.23, 0.23. Then I add it to my interest rate of 7.25, 7.3, 6.9, 7.25. That gives me a proxy of how much is this loan charging me, including the fees, on an annual basis. So the annual cost here is 7.5%, 7.47%, 7.13%, and 7.48%. So this tells us something very, very interesting. This is a much better way to do your analysis when comparing lender offers than just looking at the interest rate, because you're going to miss all these hidden fees. So what does it tell us? So it tells us, for example, lender C is still the cheapest loan on an annual cost basis, right? Even including the fees, it's still at 7.13. But let's look at lender B. Lender B was at 7.30% interest rate, which looked to be the highest. But when you actually include its fees, it's actually the lowest excluding lender C. So this is how lenders can shift cost buckets, and you may not be aware if you're just looking at the interest rate. You want to make sure you include all the fees in your analysis exactly the way that we did it here to figure out which is actually the cheapest loan. And then the last line that you look at is, what is my monthly payment? So how much am I going to have to pay month in and month out? Right now, it looks like lender C is winning, right? Because it has the lowest monthly payment also at 12.23 thousand rupees, which is much lower than the others. So if I'm sitting here doing this analysis, the way I would look at it is I'd say that, okay, first of all, what do I care about? So I care about, first and foremost, do I have enough equity to afford the house? So lender C, before I can even look at their proposal, I need to know, do I have 10 lakhs available to invest in the house? If I don't, then I cannot even consider their proposal because they're only lending me 15 lakhs. I may need 20 lakhs. So turns out I don't have 10 lakhs available. So I can throw lender C out of the analysis. They're not willing to give me enough money. So I cannot look at their proposal. So lender C is out of the running. Now let's look at the other proposals. Okay, so in terms of annual cost, they're all relatively similar, right? Lender B is a little bit cheaper than the others once you factor in the fees, but they're all mota roughly around the same amount. Now let's look at the monthly payment. The next thing that's important is, can I afford the monthly payment? Okay, so we see something interesting here. Even though lender B had the lowest annual cost, it actually has the highest monthly payment. Why is that? How can that be? If it's cheaper, shouldn't the monthly payment also be less? The reason is this tenure. Lender B is only willing to give me a loan for 15 years, which means that my monthly payment is going to be higher because there's less amount of time that I have to repay the loan. So that's why the monthly payment works out to be higher for lender B. Now, the question I should ask myself here is, can I afford this monthly payment? And if I can afford this monthly payment, then it's not a bad idea, right? Because it's actually cheaper than the other loans. But the question is, will this put too much pressure on my finances? Can I afford 18,000 rupees a month? And maybe the answer is no, I can't, because what if I lose my job? What if I get a wage cut? What if something unexpected happens to me? While I can afford it if things are good, I need to make sure I can afford it if things are bad also. So I eliminate lender B also. The monthly payment is too high. Okay, so that leaves me with lender A and lender D. And then it becomes a relatively easy calculus to do. We look at the monthly payment, lender D is a little less. We look at the annual cost, lender D is a little less. So it's very clear in this example, given my life circumstances, how much equity I can put in the house, how high a monthly payment I can afford, lender D is the right choice. So what did we do here? This looks like a lot of work. It really is easy when you lay it all out. We laid out all the key information on the loan, how big the loan was, how long the money was being lent for, what the interest rate was, what you're paying in fees. And then we calculated the numbers that matter. What is the annual cost of the loan when you include the fees? How much money would I have to pay to buy the house? Do I have that much amount of money available? And what is my monthly kharcha going to be on the loan? And that allowed us to figure out that lender D was really the best option. Sure, lender C was cheaper, much cheaper. Look at that. I mean, 7.13% versus 7.48%. But we couldn't go with lender C because they were lending us too little money. Also, lender B was cheaper, 7.47 versus 7.48. But you know what? It didn't matter because I couldn't afford the monthly payment. This forced me to decide between lender A and lender D. And then I went with the cheaper lender, which was lender D. So this is a great way to simplify the noise in finance. We're going to upload this Excel as just a model, which will be available for you to download if you want to use this for your life when you're comparing home loans or car loans or whatever. This is a great way to framework to use to help you make decisions. Okay, so that's the numbers. There are some other things you should keep an eye out for when borrowing, which are less in your face, but quite important. So one is prepayment penalties. So what are these? These are the costs that lenders charge you for paying a loan back early. So let's say I took a housing loan for 20 years, but I wanted to sell my house and move to another place. So I sold my house, I paid back the loan, and I got a new loan to move to another house. A lot of lenders will actually charge you an extra fee if you pay back your loan early. This is called a prepayment penalty. So you're going to want to understand from your lender, is there a prepayment penalty? And if you envision having to repay your loan early because A, you may want to refinance your loan and get a better rate, or B, you want to move houses again. This is a very important feature that you should also be aware of. If you're not planning to do those things, then it's less important. The next one is floating or fixed interest rate. You're going to want to know, is the interest rate they're giving you fixed, meaning that even 5 years later, your loan is going to charge you the same interest rate, or is it going to float depending on what the RBI rates are? Lenders love lending to you in floating rate loans because it lowers the amount of risk they take. But for you, it's much better to have a fixed rate loan. So typically fixed rate loans are better. A lot of times your only options are floating rate loans though. So like home loans, typically in India, they're only fixed for 1 or 2 year increments at a time, and then they become floating. So you're going to have to, this is more a thing that you can use to compare lender offers. If one is offering you a fixed rate and others offering you a floating rate, you may favor the one that's giving you the fixed rate if it's not charging you a much higher interest rate. Okay, so with that, the material we covered in last class and this class, you're equipped to borrow smartly and to use it for productive purposes, and it can be a huge tool for you. So we've covered the third pillar, and in the next class, we're going to start the final pillar, which is going to be protection. Protection is one of the areas which is something that is probably the hardest to understand why you need, because it's all about protecting you from events that are very, very unlikely to occur. So life insurance is a classic example, right? If I'm 35 years old, you know, in the pink of health, no ailments, nothing, do I need life insurance, right? The answer is most people should have some degree of protection because life is unexpected. And while the risks may be small, the consequences of those risks can be huge. And that's what insurance is all about. And insurance is very, very underpenetrated in India. Most of us are very underinsured, and understanding how to use insurance so you can sleep more soundly at night is critical. And it's going to be something that we're going to discuss in the next class. And insurance also in India is very confusing because a lot of the companies, they try and sell you not just insurance products, but savings products also, which we don't recommend. So we're going to discuss a lot of that when we discuss the protection pillar. But it'll be a very good session, and that'll be the final pillar we cover. And that'll conclude, after we finish that, that'll conclude our beginner session. So with that, I'm going to open it up for Q&A. If there are any questions, we can.
Yeah, so there's a bunch of questions. The first one is there any innovation in credit scoring?
Yes, good question. There is a lot of innovation in credit scoring. So I'll tell you how some of this stuff works, because for those of you that aren't aware, prior to Bharosa, I was working at a lender, new age lender that I helped set up called APAC, where we actually evaluated some of these new age credit scoring models. And I'll give you an example of one. So what it does is it looks at your phone data. It gets your income from your SMS history. So it can tell at any time there's been a salary credit or a debit or whatever, and spending data through your SMSs. So it's able to understand your income through your phone. It's able to understand how many outgoing calls you make, incoming calls you make, your location data. It analyzes all of that to come up with a credit score. What I tell you right now is these things have promise. They definitely have promise, but they're not being used very heavily in making actual credit decisions at most of the lenders. And the reason is there's not a lot of validation data that can be used to support whether these algorithms work or not. So this whole credit score that we're talking about here, CIBIL score, etc., there's a lot of data backing up the fact that your CIBIL score is a very good predictor of your likelihood to default on a loan, which is why lenders are very focused on your CIBIL score. Because on average, it does a very good job of telling the lender, is this person likely to repay my loan or not? Some of these new age algos, while they're promising, they don't have that history that says that, okay, this score actually works really well. It's getting there and it's very promising, but we're not there in a way where these things are being used a lot in making credit decisions at most lenders. There's some new age lenders that are doing this, but it's sort of up and coming. Next question.
When a person can afford the college fee, is it a good idea to get an education loan?
Good question. So this comes down to what the opportunity cost is of that capital. So the way to answer this question is, what are you doing with that money now? If that money is, let's just say that money is in a fixed deposit earning you 3% per year, okay? And let's say that you are looking at a college decision, the decision of whether to borrow or not with the college thing. You get some education loans and you see an interest rate of, let's say, 7% for your college loan, okay? And you get a tax write-off on that. So let's say that it works out to a 5% net fee to you to pay to the college. Now, essentially, it's costing you 5% to fund that education, right? And that money is sitting there earning you 3%. So in this case, because your return is not very high, because it's just sitting in an FD, right? It would make sense to fund it through your FD, right? Now, let's look at another situation. You have that same 5% education after tax loan cost, right? But this time you were invested in stocks and you expected those stocks to pay you 10% return, right? That was your expectation of your future return. In that circumstance, it would make sense for you to actually borrow, because if you use the stocks to pay that loan, you'd actually be giving up a 10% return. So the answer to your question is a nuanced one. So how do you answer it? One, what is that money doing for you in terms of giving you a return? If it is low, then it enhances the option of paying for it in cash and not borrowing. If you expect to get a high return, then it means maybe it makes sense to borrow, depending on if the interest rate is lower than how much you plan to earn. Because in that scenario we just discussed, if I borrowed, I would be borrowing at 5% after tax. And if I, on the other hand, were to use my stocks to pay for that education, I would be giving up a 10% return, right? So clearly the loan is cheaper in that case, right? So really it comes down to that equation. Do that kind of analysis to come up with the right answer for yourself.
Okay. Will companies like Paytm offer you credit? Also, what is P2P lending, and will that be significant in India?
Will companies like Paytm offer you credit? It's possible that they're going to move in that direction. I think they've talked about it. So yes, I expect companies like Paytm will get into the credit game more and more aggressively over time, because they're sitting on lots of interesting data. If I know how much someone is paying on Paytm on a monthly basis, and I have visibility into how stable that is, and they're using me to pay a lot of their kharcha, I can get a very good estimate of that person's spending. And if it makes my income assessment easier for that person, I've done the KYC on the person. So there's a strong logic to say that maybe Paytm will get into lending in a big way. TBD, we'll see, but I expect that to happen. P2P lending exists in India. It's very small. It's an opportunity in the future that someone cracks that and lowers the lending costs for everybody. At this stage, P2P is not probably a very good option for people to get funds, because the rates that you're getting charged are very high, because there isn't a lot of demand from investors. As that increases, it may become a very attractive place to get funds to borrow.
Continuing with the college education thing, as a parent, should I encourage my child to borrow for college? So the loan be in the name of the child.
So yes, it's a good idea to, assuming you're going to borrow, right, to fund an education, it is a good idea for you to borrow in the name of the child, because that's going to build the credit history of the child. You can sign on as a guarantor of the debt to lower the interest costs. But it is a good idea to start building the habit of getting the child to repay the debt, make sure he's set up on NACH, and it builds a good discipline, and it will help the person understand how borrowing works and the regularity of repaying, and help them build a credit score. So yeah, it's a good idea.
Okay. Should you give a personal guarantee for your business, borrow against stocks, property, land, etc.?
I do not think it is a look. It's all about risk and reward, right? When you're doing any kind of borrowing transaction, what you need to ask yourself is, what are these funds going to do for me to create reward? So in the case that the person talked about, they're going to use it for the business, right? So using it for a business is a very good idea. It's productive. If I can borrow money to make my business better, let's say I'm a dentist, okay? And I notice that I don't have an X-ray machine, and all my patients have to leave my office to go to a radiologist to get X-rays for their teeth. And the radiologist is collecting all the fee. My customers are unhappy, and this makes no sense. But I don't have the money to buy an X-ray machine. Okay. It makes a lot of sense for that person to borrow to get the X-ray machine, depending on the borrowing costs and if they make sense based on how much incremental profit they think they can get, because they can make the business stronger. So borrowing for a business is a pretty good idea usually, provided that you have a lot of visibility that whatever you're using the funds for will work. So there are lots of examples of businesses that borrowed that failed, right? Just look at, Cafe Coffee Day, right? As a good example. They overborrowed and they used that borrowing for all rubbish purposes, and created a huge problem, right? So we all think that our ideas are going to work. The trick with evaluating whether borrowing is smart or not is figuring out what are the risks I'm missing. Obviously, I think it's going to work, but am I asking enough questions to really understand if it's going to work or not? What could I be missing? Now, let's get to the question, right? The question was, should I be giving a promoter pledge, personal guarantee, lending against shares, etc., etc.? When you do things like that, what does it change? It changes a couple of things. One, it may reduce your borrowing cost because you're giving the bank more security. If you're saying, I'm going to give you a personal guarantee, then you're saying not only is my business on the hook for repaying this loan, all my personal assets are also on the hook, like Vijay Mallya, right? He did with Kingfisher Airlines. Now, that will obviously lower the cost of borrowing. Why? Because the lender has less risk that you're going to default, but you have a lot more risk when you give something like that, right? Suddenly you've transferred risk away from the lender, the lender, and transferred it to yourself. Now, is this a smart idea or not? It all depends on how sure you are of the idea working. If this is a 100% slam dunk idea is going to work, no chance in hell it will fail, then by all means, the lower you can get your interest rate, the better the profits will be for you. But you know what? In my view, there are very, very few things, actually no things in this world that are free lunches. Absolutely nothing is a free lunch. There is always risk in whatever you do, and My only concern with giving personal guarantees is that you're ramping up the risk. You need to make sure that you're comfortable with that risk. Okay. I would not do something like that personally because I don't want to expose my personal assets to undue risk. Uh, but that's the kind of calculus you should do in your head. How sure am I about the opportunity? And what happens if I'm wrong? Am I okay losing my assets or a significant chunk of my assets? That's kind of calculus. In terms of loans against shares, again, I don't recommend this. Shares are very volatile, and it's risky. Again, a lot of it depends on how confident you are on what you're using the shares for. So that's kind of the advice on the loans for shares. What other questions do we have, if any?
Yeah. So if I have funds in a bank and a home loan running at 8.85%, I'm taking home loan interest and principal deduction advantage in income tax return. In the current scenario, when the bank interest rates are very low, should I prepay and complete the loan?
No. So it's a good question. So, yeah. So the person that's asking the question is doing the exact right calculus, which is what am I getting for my excess funds? And it's a very low rate, right? What am I paying, which is a very high rate? So actually the person who's asking the question is doing the exact right math. So from a purely financial perspective, if you're paying a lender 8.5%, you're getting the tax deduction. So maybe that lowers your rate to whatever, I don't know, 6.5% or something. And you're earning 2-3% FD rates, right? From a purely financial perspective, it makes a lot of sense to prepay the loan, right? Because this is expensive borrowing relative to what you're earning in the bank. So yes, from a financial perspective, it makes sense. The only other things I would encourage you to think about when factoring in the calculus is you've done the exact right first step. The second step to making sure that this is a good transaction for you to do is you want to make sure you leave yourself with enough liquidity to handle unexpected events, right? So your money that's sitting in a bank account, it does two things. It gets you a return, which is one very important factor. But perhaps the more important factor of your cash sitting in your bank account is it helps you manage your daily expenses and your liquidity. If something unexpected happens, your car gets into a crash, insurance is not going to cover all of it. You suddenly need to pay 1.5 lakhs of money, right? That you didn't expect to pay. Where are you going to pay that from? Your cash, right? So the second step in the analysis that must be done before you prepay is you need to make sure you have enough liquidity to handle things like that. Once you've done both those analyses, so first one you've already done, you did a great job on that, definitely makes sense. Second piece is, do I have enough liquidity? If you do, then prepay. Make sure you've left yourself with enough liquidity. It's a great move to prepay in that case. And by the way, check on prepayment penalties also. You want to make sure you factor that into your analysis. Typically, home loans do not have prepayment penalties after the first 1 year of the home loan. So you should be okay.
Okay.
Very good question.
There's another comment on the part on insurance and loans about lenders making you buy insurance through them. You should know your rights. A lender cannot deny the loan because you do not buy tied insurance. Start your research well in advance. Important decision. Amazing the amount of research for saying a housing loan is much less than whatever. Anyway, yeah, there's a lot of research that needs to be done.
This is a fantastic point. It was in the slides, but I forgot to actually bring it out in the voiceover. But this is a critical point. it is optional for you to take the lender's insurance. So thank you very much for the listener for pointing this out. This is a very, very important point. You can always opt to get your own insurance in lieu of the offer that the insurer is getting. And this typically makes a lot of sense in some cases, because you would not believe how much of a commission some of these insurers get from the insurance companies. Having worked in the space, I know that housing companies can get, 45, 50, 60% commission on the premium you pay for insurance. So this is something that you must see if you can get a cheaper deal from the insurance side. So thanks for the listener for pointing that out. Great point.
Okay, so I think that's it for the questions. There are no more questions, so we can conclude the session.
Great, but I'm thrilled to be seeing the depth and level of the questions. I think a lot of the analysis you guys are doing are spot on. You guys are proving to be masters at personal finance by thinking about things in a very logical and very sophisticated way. So I want to applaud you all for that. And that's what we're all about, sharing insights like the listener just did about insurance, where we can all benefit from the work that we do in our personal finances. So great comments, great questions. And we'll pick up with our advanced session next week. As I said, I think I'm going to do a research-driven session on analyzing a few companies or in the next few advanced sessions. But I'm open for suggestions. If any members have topics that they want covered, let us know. And if we think it will resonate with a lot of our members, we're happy to do that. So thanks again, guys, for joining, and please spread the word on the club. And thanks again. Bye.